Welcome back, students. Let's continue on with production. We talked about the different types of market structure. Now let's take a step back and talk about the basics of how companies calculate their decisions. Some of this may seem a little bit familiar from accounting. First of all, firms need to have the most profit they can. We call it maximizing their profit. Profit is made up of revenue, which is good. It brings money in from your customers, minus their cost, which is bad. It reduces the money that you keep, and you have expenses. So firms have to try to figure out how to make the most of this situation. The most revenue at the least cost will equal the most profit. So if you sell a hot dog for $5, and it costs you $2 to make it, so 5 minus 2, that's going to give you a $3 profit. And if you make 1,000 of them, that will be a $3,000 profit. So that's how this works. Revenue is the money you make from sales here. So the price times the quantity. So in this case, we would say $5 times 1,000 would give you 5,000 total revenue. Your total cost would be $3 times 1,000 would give you 3,000 cost, and you'd make a $2,000 profit, 5 minus 3. For your demand, you have to figure out when you set the price, how much will your customers tolerate? So remember, in perfect competition, you have to accept the market price from the consumers, the most that they're willing to pay, because you have no power. But if you're a monopoly, you can charge whatever you want, and the consumers cannot do without electricity or water, and they have to come to you. So in that case, the monopoly has the power. So the revenue that you can make depends on how much demand there is, and that demand is going to depend on how much competition you have for that demand. So you say revenue is a function of a demand. You can think of this function as a percentage, for example. So if the demand is for 1,000 units, then your revenue might be $2 a unit. So $2 times 1,000 would be $2,000 of revenue. Or in the example I gave, if the demand is 1,000 units from the customers, and you charge, your function is to charge $5 a unit, then your revenue would be $5,000, as in the previous example. So that's your revenue. What about your cost? Your cost comes from a production function, which tells you how much do I need to put in cost-wise to make the product. We usually don't look at materials in economics because it's too simple. We look at mostly in economics, the production function, how much you can make depends on what quantity. This would be some percentage of labor and the capital. So or some quantity of labor and capital. So to make a pizza, you might need 3 workers and a 1 pizza oven. And that would be your labor and your capital equipment. And that would tell you if you have 3 workers and 1 pizza oven, so that would be 3 of one and 1 of the other, you might be able to make 1,000 times the amount of labor. So the function of labor would be 3 laborers times 1,000 times would be 3,000 pizzas. Or you might be able to make 100 times the amount of your capital. So if your capital is $500, you might make 100 times would be your function of $100, of $500. 100 is your function of $500 in capital. You can make 5,000 quantity. So this was like a part of your cost that comes from the quantity, and then times the cost of each item. cost of your workers, and cost of your capital. So also price times quantity, but in this case, the price would be your cost, and your quantity depends on your cost side, depends on your inputs, how much labor and quantity of capital you need to add. Now we have another idea called a marginal product. If you remember, marginal means extra. So your extra product is how much extra product you can get from each worker. Your marginal product is equal to the change in your total production divided by the change in labor. So marginal product is change in total production times change divided by change in labor. That's your marginal product of labor. And you could do the same thing, as we call it MPL. And you could also do MPK by seeing how much more products you get for each unit of capital. So what does this mean? If I can get 300 more units for every one worker, then my marginal product of labor is 300. 300 divided by 1, as an example. So we're going to pause there and take it slowly.